There aren't many things that we hold as dear and near to our hearts as sex and money. Well, we're not going to talk about sex today, but we will talk about money. And I'm very excited to have a financial planner, a personal financial planner to help us guide through the maze of financial policies, processes, and how to maximize what you get to keep after you make your money. So today I have Stacy Astor. She's a personal financial planner from Mill Valley, California. She has clients throughout the entire country, and I'm super honored to have her on the program. I don't know why, but it's difficult sometimes to get these financial planners to come on here to talk, to share their knowledge and share their secrets. So welcome to the program, Stacy, and thank you so much for coming on.
Thank you, John. I really appreciate being here. Hi to the group. I wanted to also thank Lisa Finkelstein, who introduced me to John. Lisa's my closest friend from childhood back in Philadelphia. I moved to LA in Orange County in my early 20s and have been there 20 years and then 20 years up in the Bay Area. So let's see.
So first of all, I want to encourage the audience members who are watching this on Facebook Live to feel free to ask any questions in the comments. You can type them out and I will feed them over to Stacy, and we will definitely do our best to answer all of the questions for you. And Stacy has prepared a very, very short presentation, and I looked over the slide deck, and I think it's going to be very instructive for a lot of the audience. Go ahead, Stacy. Sorry.
Thank you. Not at all. So my company, Astor Financial Group, we're in Mill Valley and San Francisco. We're a high-touch boutique firm that provides holistic financial services to businesses and individuals. We offer goal-based individual wealth management and business services strategies. Astor Financial Group's an independent, this is my little, spiel, financial services firm dedicated to helping clients maximize growth and, most importantly, mitigate risk. We work with physicians through all levels. We have worked with many physicians as they're starting in their practice, and also employees throughout their entire practice and through retirement. We also have worked with physicians through to their passing and helped them pass their wealth on to their children and grandchildren. So in fact, we've worked with 4 generations.
Yeah, that's really important. A lot of us are just concentrating on, okay, well, how do we make the money? How do we keep the money? But not many of us are thinking about succession planning, which is something once you get to a certain spot, then that's the next phase for a lot of us. But I think we're concentrating on just the earlier phases because that's where most of us are in, right?
Right, exactly. And just to remember that financial planning is a long game. You have both short and long-term goals. And so we're going to talk about what some of those might be and how to get there. Let's see. So are we going to go to our slides?
Yeah, I'll go ahead and show the slide deck right now. Here you are. Go ahead.
Okay.
I have your first slide on the screen.
Okay, I don't see it.
Okay. I'm gonna advance the slides. Agenda. I have the agenda slide up, so go on ahead.
Okay, so I don't know why I'm not seeing it.
You're not going to be able to see it.
Us. Oh, I'm not. Okay. Well, then I didn't know that. So can I take 1 second and pull it up?
You bet. So we are here today with Stacy Astor. She's from Astor Financial Group in Mill Valley in the San Francisco area, California. She has clients throughout the country, helping them with financial planning throughout the careers of many professionals. And she has dealt with, obviously, people in San Francisco, the people in the tech sector, and helped them with their finances. A lot of people start out in California, but then they move out of state. Her firm handles personal finances, professional finances, as well as insurance, which is a big part of planning. Personally, for me, I know I have the portfolio or retirement plan and things like that, but then also I have insurance, life insurance, and different types of life insurance to make sure that my family is taken care of on my passing. Not something that we always want to think about, but it is important to think about. And I tell you, it is such a great peace of mind to have that set up for the kids and for my wife. How are things going there, Stace?
Okay. All right. We're fine. I
All right.
just, going to move this way because, okay, good. All right. So financial planning 101 is what we're here to talk about.
Yes.
Also, I'm going to go through some investment terminology, some resources that we have on our website, and question and answers. Okay.
And we are going to be dedicating a lot of time on Q&A. And feel free, anyone watching, feel free to ask any questions in the comments, and I will pass those along to Stacy.
Thank you. Okay, the next slide.
Okay.
This is our financial planning overview. So the most important thing is understanding when you're talking to a financial planner or any other financial advisor, what's their background? How did they get started? If you don't know if they had to, earn commissions in those first few years and possibly be a little more aggressive, or if they started out working in an accounting firm, if they, what their degrees are in, or if they started out in the insurance business. Personally, I started working for another financial planner. So I was a salaried employee. And then 4 years into my working for him, he went into physician practice management. And so a large bulk of our clients were physicians. And so I ended up buying out his business. So that means that and at the same time, I was studying to be a financial planner. So that's how I came in. So that's my scope. So everything I do and talk about is always a top-down approach. I'm always thinking of the integrated approach with all these different aspects. So starting with, you can see retirement planning, cash flow analysis. Oh, in the parentheses is Astor Financial Group, AFG, or if we work with another advisor to help us for you on this category. So cash flow analysis, sometimes you're working with a bookkeeper or your spouse looking at your budget. Debt management, college savings, tax planning, you're usually working with a CPA. Estate planning with an attorney. Risk management, that can be either an insurance agent or sometimes the financial planner also sells insurance. And investment analysis. And even, again, a financial planner oftentimes is also managing money, not necessarily. And also they could even work with other brokers if you have multiple brokers or investment advisors. Okay, let's see. Hold on one moment. One of the things I wanted to point out, some of you I know are employees of companies. Some of you may work for small practices. Some may be partners or owners or sole proprietors. So when I'm talking, I'm going to try to address from all levels. Let's see. Financial planning is an integrated holistic practice, as you can see from the slide. Okay, thank you.
Can you kind of talk about what does that mean? What is that holistic? What does that top down mean?
Yeah. So it means that when I'm talking to you about, let's say, retirement planning, or better yet, when I'm talking to you about your practice and you come to me and say, okay, this year, besides my normal salary, it looks like we're going to have X amount extra in profits. Well, I'm thinking, well, who wants to pay extra money in taxes if you don't have to? So I'm going to think of all the ways I can to, go through with you your entire practice budget and see where can we write off more items. And one of the largest places would be in retirement planning, which we'll get to later. And so that would mean that not only are we dealing with tax planning, corporate tax planning, then we're dealing with retirement planning. Then I'm going to be suggesting investments. And then I have to consider, your risk tolerance and your cash flow of your corporation to know what you can afford to pay into a retirement plan. So all the different aspects end up being involved. And ultimately, of course, this is for you, your retirement plan. And then if among your later when you pass, it could be possibly for estate planning. So everything gets integrated.
Sounds good. Did you
We
want me to
can
go
go
on to the
to
next
the
slide?
next slide.
You got it. Okay.
Oh, one other thing I wanted to mention on the financial planning slide, sorry, is that we're also a team-oriented, we look, like I was mentioning, team-oriented solutions. We're very inclusive, and you want an advisor that's open to questions, that solicits advice from these other advisors. You know, you're part of your team. And usually the financial planner is the hub. So we're the one that has to think about, we should really let your CPA know, because we usually hear things first of what's going on in your life. And so we'll make sure that you, like we might say to you, please make sure you tell so-and-so this, but we might do it also just in case you forget. But yeah, so it's important that you think of us as your team, because a financial planner is kind of like either how an internist would approach things, or like when I was talking to Lisa, she said, when you're planning for your surgeries, how you plan a surgery, it's taking everything into account. Also, we're looking at risk and reward at all times. And when I talk about risk, there's a sleep factor involved with everything you do, whether you're being aggressive in certain ways, being really busy in your practice. You want to make sure you have balance in your life, and that you're also with your investments, that you're able to sleep at night if you know you're taking big risks in certain parts of your life, that you're comfortable with that. So
A lot of
the
people,
financial,
a lot of
yeah.
people just say, okay, risk tolerance. Risk tolerance for those who are not in financial planning or investment means
Right.
at different parts of your, to me, it means that different parts of your life, I'm willing to tolerate certain types of risks in the investments that I choose. For instance, I'm in my mid 50s and I'm still earning income, and I have some of my money in stocks, and a good amount of money in stocks, because I'm willing to take the risk of losing some of that money in case the market drops. Whereas someone closer to retirement, or who doesn't have a balanced portfolio, they may, if they're closer to retirement, let's say, you may want to put more of your money in the investment, in your portfolio, in your wallet, if you will, in instruments, in financial instruments that are not as subject to the fluctuations in the market. So that's what I think Lisa's talking about when she talks about the risk tolerance.
Right. And also, there's an old adage that and it is old, the age you are is how much you should have in bonds. So if you're 70 or 80 years old, you should have 80% of your money in bonds. That also was said at a time when people were living like only till like 70 or 75. So we're usually not that conservative. You know, my 70-year-olds, you know, probably have a 50-50 split, or a 46, you know, around 50-50.
Yeah.
But again, it depends
varies
on the rest of your life,
right,
and the balance you have and other things that you have established.
And yeah, a lot of physicians think that we're very, very smart. Like we can figure things out. Why do I
Right.
need a financial planner? For me, the way I think of it is, what am I best at doing? I'm best at doing urology. I don't have the time, really. I
Right.
mean, when I'm seeing close to 50 patients a day, I don't have the time or the energy to read the tax code, to read about the latest changes, to follow up and to keep up with the trends in the market.
Right.
And that's why I need someone who kind of guides me, even though, yes, it does cost a little bit of money, but I think the cost of me not doing anything would be a lot more than doing something smart with my money. And I know there are people who say, yeah, just read the White Coat Investor, follow John Bogle's principles. Yes, I can do that. And I've read
Right.
some of the books, but it's still good to have someone in my corner kind of guide me and make sure that I'm doing things correctly. In addition, depending on the type of plan that you have instituted, you want a fiduciary or someone kind of in charge in your corner to make sure that you are in compliance. So anyway,
Right.
that's my 2 cents.
So you're bringing up a couple good points. One, so I'll just react to that. One is when you talked about risk, I'm thinking about all of you urologists. I can only imagine that when you're, over a patient in the middle of a surgery and something goes wrong, you know what all the potential risks are at that moment in time. You know what you have to do and what your chances are of trying to. Do I need to be centered?
Yes.
Okay. Is that better?
The other way.
Sorry. Is that good? Okay.
You're good.
So, yeah, you know what that risk is and whether or not you're going to take a chance, for a more positive outcome on that particular patient. That's the same thing. You can't know, no matter how much you study, you can't know what we have in our head and all the risks we're thinking about. The other thing is, John Bogle from Vanguard Group is who you're referring to. So in case people were wondering who that was, and he just passed away, recently. A Vanguard, truly, no pun intended, in the field of indexing, and fiduciary. Fiduciary is a hot topic now in the last couple of years, but really, it just means that the person that's managing your money should be using the utmost safety measures and trust. And to me, it's an kind of an overkill topic because that's what our job is. That should be embedded in us. That's our main point of being here, is to be protecting you from every angle, to get you to safety and retirement.
All right. Shall we go on with our next slide?
Yes. Okay. So we have wealth management, which you guys can all read this, of course, but they're just different strategies to enhance your assets and your income, reduce liabilities and expenses, and increase your overall net worth. That's our goal. Retirement planning, again, just goal setting and assessing your different sources of income later in life. Risk management, which is making sure how insurance plays an important role in protecting all your family's assets. Disability is a must. For those of you that are starting out, 35, 40, you really have to make that the priority because, obviously, I have no idea how much you guys learn in medical school, but your hands are your biggest asset. We need to protect your hands. And tax planning, working with a CPA to optimize results. And John and I were talking about, it's not how much you make. Everyone wants to talk about how much you're making, bragging about how much they make. No, it's what you keep. So taking taxes into account. So we'll talk about that later. And estate planning, which was working with an estate planning attorney to minimize and eliminate estate taxes, which you know nothing about because you're all probably young. But basically, it used to be, and it used to be that anything over like 650,000, you had to pay 50% in taxes. So now that number is up to, I think it's 11 million. So you're safe for a while to not have to give more assets. You can go to the next slide, John.
Okay.
Thank you.
Financial planning steps.
Yeah. So a financial planner does have certain steps they go through. And I just thought it's worth mentioning. The most important thing is talking to you. So discovering what's important to you, what are your goals, and helping gather all the necessary information, your tax return, all your any investment statements, your like where you work, and you're looking at your enrollment package and making sure that we can optimize what you have there. Then we go into.
Can I interrupt you here for a second?
Yeah, please.
Discovery phase. During my discovery phase many years ago, my planner put it together in a spreadsheet of assets, liabilities, and created a picture, an overall picture of my financial situation. And that is one time in my life where I felt, okay, this is great. I feel a little bit more at peace with what's going on because it gives you a good picture, a good sense of control of what's going on. in a world of uncertainty in life where
Absolutely.
many things are uncertain. The other area, the other time where it gave me a lot of peace was coming up with my estate planning, if you will, meaning creating a will and trust and all that stuff. So those two situations gave me a lot of peace and a lot of control because now I know I'm taken care of and my kids are going to be taken care of. So anyway,
Yeah,
just
well,
just
of
as,
course.
as an aside,
Yeah, no, of course. I mean, who are you doing this all for,
yeah,
right? You love working and that's great, but usually you're doing it, the love for your family and you want to help them, have all the opportunities for your children and for you and your spouse
yeah, that
in
I
life
that
to
I
have,
have to struggle through to get to where I am. Okay, step number two.
yeah,
Go ahead.
yeah. And a lot of times people starting out, it's not very pretty. It's like student loans on one side and nothing else on the other side.
That was me.
you know right, so but we help you get there and work on, at what rate do you work to pay all that off and then start building in retirement plan. Fortunately for physicians, they can catch up a lot faster than some other people with student loans, at least. Let's see, so yeah, analysis. So how can you reach your goals? We will show you the picture of how to get there. Also, creating a goal-based financial plan. That's something we've been doing a lot more of the last couple years. There's great software out now. We use eMoney, and it's amazing what we used to have to do on Excel spreadsheets that we can now just plug in a whole bunch of scenarios, and you can actually see how long your money will last and how it grows differently under different scenarios. And then we help you with the timeline, of course. Lastly is implementation and plan execution. Let's see, one second.
And that's a big and that's a big part too because great, you set all these goals and you know your financial picture, you set a plan in place, but I get distracted with my work. So I'm not keeping an eye on my financial situation, and if it weren't for my planner whom I meet every quarter, I would kind of set everything on cruise control and not make the necessary adjustments necessary to reach the goal even more efficiently.
I like that. The 2 points. One is you have to talk to your financial planner, because how are they going to know what's going on in your head and in your family's, under your family's care? And also the 4 times a year. That really depends on the person. When you're starting out, it might only be once or twice, but you should be able to feel confident that you can email or call the financial planner for like simple, all kinds of things that are crossing through your head. It's not just you can only talk to them when you're, in meetings.
You bet.
Also, like if you end up having to refinance, there's lots of things that you should feel confident. And I'll talk about that a little bit more.
Yeah, I tell my planner everything.
Good. Yeah. Yeah. I was going to say, like, for the women, it's your hairstylist. I shouldn't be gender biased, but okay, let's go to the next slide.
You got it.
So retirement planning. Here's the big question. How much do you need to retire? Oh my gosh. I've been thinking about this a lot, imagining being, 35 or 40. It really depends on what your standard of living is, how you expect to live in retirement, and how long you think you'll live. And I was thinking about it. Like, we now know for certain that people are going to be living, for the most part, till 85 or 90 and beyond. I have clients 101. I mean, it is crazy. I have a lot of clients, a lot, that are making it to 85, 90 and beyond. So the hard part about that is you're working like 30 years, 35, depends on what age you want to retire at. I try to help my clients be able to retire by 60. If they want to keep working until 65 or 70, fine, that's up to them. But I want to be able to give them the option. So that means, if you're not even working 30 years and then you live to 90, you have to fund for 30 additional years that you're not even working. And maybe you'll be working doing something else you know, now that we are living so long, some people have multiple careers. So even as a physician, um, I mean, Lisa's a great example. Um, having a urology practice and now being heavily involved in telehealth medicine. And I don't know the exact title, but Wyoming's
Beyond
telehealth.
Telehealth is Lisa Finkelstein's new venture.
Yes. So, but yeah, there's lots of room to be creative in our world, and we want to make sure we fund for that so that you can enjoy your one life, at least in this life. Let's see. Um, so we are going to talk about how much you need to retire. But the other thing I was thinking about is at 35, you don't know what your standard of living is going to be. At 40 and 45, maybe now you have children and maybe you're spending a lot more money and having a bigger house, but you don't know how you're going to end up from 45 to 60. You don't know if you're going to downsize. You don't know if you're going to upsize. You don't know if you're going to move to another state to be, that's less expensive, or move to another country. So all along your life, you try to think about what might retirement look like. And I think that once the children leave once they're done college, I think parents have a better idea of, I don't need to spend as much as I've been spending all these years for fun. Maybe it's more important that I use that money in a different way, or don't need to save as much so I can, have fun the way I want to have fun later. So things to think about. Okay, the power of compounding. Compound growth is an amazing concept.
I didn't learn about that until I was in my 30s.
Yeah, compound growth. I was very excited. Besides physicians, I have a couple other segments of the population that I work with. And because my husband was a video game programmer, I have a lot of video game clients. So I was fortunate enough to help a company when they first opened. And these guys, the youngest I think was 21, but they were mostly 21 to 24. Can you imagine? And they were all making $100,000 at the time, which was outrageous money back then. But you could only put $6,000 the first year in your 401k. That was the maximum. So now it's $19,500. But back then, I was thinking that I helped all these young guys put in their $6,000 a year, and then it went to $7,000, so $7,500. So I was thinking, I believe we did it for like 4 or 5 years, and right now they're all around 50. And I think the money is like close to, you won't believe this, I think it's like $300,000. It's crazy. So doing $6,000, $7,000 for 4 years, and it turns out to be like 300,000 30 years later.
So I think that a lot of people don't grasp how that works. So
right.
these guys put in $6,000 a year for only 4 years, and they let that money sit, and that money's making interest. So now the initial amount that you put in plus the interest is now making more interest. So that's compounding. And a lot of people don't realize over time, if you have time, if you have the advantage of time, which in a lot of physicians, we started out in debt, we missed out on that. So now we have to catch up. And that means you have to put in a lot more to catch up to those guys and gals who put in money early on. But that initial $6,000 for 4 years with compounding now is how much?
It's over 300,000.
Isn't that amazing?
Right.
That is something that blew me away when I learned about it back in my 30s. And I thought, oh my gosh, I am so behind the 8 ball.
Well, the thing is, now I feel the next generation, they might not have it as easy. So I'm going to do a quick little shout out to the older physicians, if there are some here that might be listening. And so the people that have children that are now like 18 to 25, it's a perfect time if you want their lives to be easier, and you can teach them values. It's not being overly giving or making it easy for them. But a lot of times you can hire them into your practice, even for a summer, or you can, as long as you pay them like $6,000 then you can help set up a Roth IRA for them. And if you do that again for like 5 years and they're in their 20s, I calculated out that by age 65, if you do $6,000 for 5 times, I think I did 5 or 6 years, the growth on that money year after year, growing upon each previous years of growth, at age 65 will be $1 million. So now $1 million will probably be like $400,000 in today's dollars, because that brings us to the next point, which is inflation. It's a hard concept, and we don't know what inflation will be. It's been about 2% for the last 20 years. And every time, like we're in a period now where everyone's worried, oh, inflation is going to rear its ugly head, and everyone gets all like panicked. But that just means that the value of your income that you're making will feel like it's less money to you, because the cost of goods and services will go up. And so your money won't go as far. So a technical definition, inflation is an upward movement in the average level of prices. Each month, the Bureau of Labor Statistics reports on the average level of prices when it releases the CPI, the Consumer Price Index. And anyway, so
what inflation
it's still
means
giving your
to
kids
me,
a big head
sorry
up.
Sorry to interrupt. What inflation means to me is the dollar that I have today is not going to be able to allow me to buy the same thing or as much as my dollar in the future because of inflation. The worth of my dollar today is not going to be as much in the future. That's the way I think. Very simple. I think very simple terms.
Right. I have another totally strange example, but a video game client actually who is from Russia. And so apparently this is, I think it was like 6-7 years ago. The inflation in Russia was like, I think it was like 10% a month or something like that. So he was having to pay his salaries to his employees. Like every month he had to raise their wages because they were losing value. And so ultimately he ended up moving his company to the Ukraine because it was stable there. So crazy, because we've never experienced that kind of inflation.
Yeah, stable currency. A lot of people don't realize stable currency, such as the dollar, is super important when it comes to international trade. But I'm going to go to a couple of comments. Dr. Sanders, who's a champion when it comes to saving, he's going to be retiring very soon. He said, I was fortunate enough to have started compounding in my 20s. And he's now in the exponential phase in his 50s. He'll be retiring in less than 2 years. And Lisa Finkelstein, the key is start early in life. But I will tell you, you don't have to start early in life if you missed out, if you didn't know about compound interest. Like I didn't know about compound interest in my 20s. So you can still catch up and you can still get into that exponential growth. And anyone with questions, please feel free to leave them in the comments. And I'm sure Stacy will answer them gladly.
Yeah. Okay, let's see. You want to move to the next slide?
You got it.
Oh, and the other thing I wanted to mention on inflation too is investments in general. You're trying to earn, if you can earn 4% over whatever inflation is at the time, that's your target. So if right now it's 2% and you manage to earn 6% return, 6 to 8% is a historical average when you take into account those 20, 30 plus years and those negative 20 to negative 30% years.
So that's okay. So for some people may not grasp that concept. So inflation may be 2%, and you're saying that whatever money that you put away, you want that money to make at least 4% above whatever the inflation rate is, just so that you can keep up and make your money earned and do the work that's necessary so you can have a comfortable retirement. I like to dumb things down like really, really basic, because I know you and I understand it, and we can talk pretty high level, but that I want to make sure everyone catches on, because I think there's such a big gap in financial education for those who understand it and for those who don't. And I think those who don't are going to be missing out. And that's why I'm doing everything I can to try to get this information out to people.
I appreciate it. Yeah. And also, the general population talks about making money like it's so easy. Oh, yeah, I made, X amount of my stock. And, people can brag all they want. Of course, they're not going to tell you the bad investments. So you just focus on what you're doing and not what everyone else is talking about, and
And
focus on 4% above inflation.
and one thing you alluded is that you mentioned the ups and downs. On average, the trend in the market is up. You are going to
Yes.
have periods where you lose a lot of money, like in a day, the market tanks because of some tax plan that is potentially going to be implemented. So there, it may have prompted a recent sell-off this past week. So the market kind of drops, but then overall, if you look at the trend, it is going up steadily. If you forget about
Absolutely.
the daily or monthly ups and downs, the overall trend is up. And I think the hard part is having the discipline to continue to dollar cost average or steadily contribute to your retirement. And that is the
Right.
hard part.
That is a hard part. The other thing too is people get scared about corrections or potential crashes. And what I try to think about is, what is the market? It's comprised of all the companies in the United States, I mean, our domestic market. And so if you think about, do you believe? Do you believe in the United States and our economy? I mean, I look around every day and I see so many new innovations and so many new exciting things. So I believe in us. And so that's why I don't falter with my commitment in the stock market.
As long as we don't fall prey to certain trends towards socialism. Anyway,
Yes.
so I digress.
Well, just certain trends in general. There's plenty of them out there. Um, okay, so let's see. Retirement planning. Yeah, it's a long game, as we've already been discussing. Um, let's see 1 second.
Dr.
Oh,
Sanders made another comment. His son has been working as an engineer for less than a year and has maxed out on every possible deferred compensation and putting the rest in index funds in his 20s. Wow. The fruit doesn't fall far from the tree, as they say. Well, he's been
right.
well taught. And that's such an important point. It's not just financial education for you, us, but it impacts on your children and
Children.
how they manage money because they all learn from by example, right? The education starts at home, not really at school. But it's important that you learn these principles so that you can pass it on to your kids so that the
Right.
generation wealth doesn't disappear in 1.5 generations.
Yeah, I mean, you're bringing up another important concept, which is the philosophy of money, and there's so many people that are raised in situations where they were poor or barely getting by, or where the parents never spoke about it because they were embarrassed or had shame around it, or it was scary. For you don't even know the reasons unless if you either ask your parents or ask your grandparents, which is a great thing to ask your kids to do if you don't feel comfortable, is tell them to, ask your grandparents for like a successful story and an unsuccessful story around money that they've experienced in their life. It's a fascinating topic and it opens the generations to talking. But yes, part of what I do, part of Astor Financial Group, um, our key, like what makes me excited, is the intergenerational process, because I didn't have that fear. My grandfather spoke to me, and like one of the things he told me is, um, when you own a home, and then if you get a larger home, always keep your first home and let the tenant pay your mortgage. And I was like, wow, what a concept, you know? And so the people that have shame or some embarrassment or some issues because of their parents, I mean, one, let's say it's not yours. You don't have to hold on to it. It's from them. So that's one, is dealing with the psychological aspect. And two, as you learn, share with your kids, because then when they grow up, they won't have any of the stigma around it and they'll feel more free to talk and to listen. Okay. Okay, slow and steady wins the race. That's my favorite slogan. Um,
It's hard
again,
because you see that people bragging about their the Dogecoin and cryptocurrency, but then what happened? You know, what is it? Cryptocurrency. What is the most common one? That Bitcoin dropped what 50
right,
billion in a day. People don't talk
right,
about their losses, like you said. Anyway, slow and steady
right,
wins the race. I totally agree. There there the overnight millionaires are extremely rare unless you win the lottery.
right, right. And there is that the Millionaire Next Door book. That's a plug for that because for people, it's a really easy read, and it shows you how you can get
And
to your
yeah,
financial
the
goals.
millionaire next door, they're not driving Teslas and Mercedes and Porsches. And you'll read
Right.
in that book that they actually drive used cars.
Now, I just was going to say something. Okay, I think of it in a second. Um,
So slow and steady wins the race for sure.
right.
And that, like Dr. Sanders said, you already said EE, maximum deferral and Roth option.
Okay. All right. So what I'm going to go over here is some basics on your retirement plan. Um, so as an employee, EE is employee, you should be focusing on the maximum deferral you can. A lot of retirement plans now have a Roth option inside them. So sometimes smaller companies don't know it's available, and TPAs or financial advisors that are not retirement driven, like some financial advisors are investment driven, they're not necessarily retirement plan design driven. And so you can always just email your HR person or your the one of the practice owners and say, we don't have a Roth provision inside our 401k, and I heard it doesn't cost anything to have it. So you definitely would like to offer that to your employees
Can
because in the bigger practices, you really want to look good with your hiring, and by having a 401k plan that's robust and has these other options looks really
So Lisa,
progressive.
if I'm sorry, Stacy, if you don't mind, I'm going to dumb this down.
Yeah.
Maximal deferral.
Oh yeah.
What does that mean? Because
Sorry.
people don't understand what deferral means, and you
Yes.
already lost them with TPA. So what's maximum deferral?
Thank you. Thank you. Okay. So first of all, a TPA is like the CPA for a retirement plan. So it stands for third party administrator. You would only deal with them if you were the owner of a business or if you were like the operating business person in your practice. Um, maximum deferral in a retirement plan, it's become more and more popular to have what's called a 401k. Now, and if, and I was also thinking that there may be a lot of husband and wife, both people being physicians. So it may be one person has a plan and the other one doesn't. But in any event, in a 401k, each year there's a maximum that the government will allow you to take out of your payroll and put into this separate retirement plan. When you do that, you can do it either on what's called a pre-tax basis, which means you don't have to pay federal or state taxes on all that money that you put aside, or on an after-tax basis, which means you do pay the taxes, but when you put it in the retirement plan, you never again will have to pay any tax on any of that compounded growth we spoke about.
So that is a super important concept, and I think I want to emphasize this. Deferral, like you said, you can take whatever you get, that the gross revenue, like the top line revenue, right? So
Mm-hmm.
you take that money and you put it in a special type of account without
Yes.
having the taxes taken out first. Okay, so that money you're putting in a special account, which then makes you money. So
Right.
that's one way to do it. The other way is your gross income, but then your taxes are already taken out. Then whatever's left, you take that money, you put it in some other special account that makes you interest, except the interest that you make in that account, you're not taxed again. So
Correct.
if I'm not
And we'll be going over it more again later. But the Roth, if you're, uh, I'm always happy to talk more about Roth, even if you want to contact me afterwards. But it is not not for everyone. So some people, they really have to decide if I'm going to be able to do only a certain amount, which way do I want to go, and do I want to get that tax write-off? And so you can have both even in an account. So sometimes we recommend do 50-50. 50% in the pre-tax and 50% in that Roth portion. And then as your financial situation gets better, you can move more and more to just the Roth portion, because you can imagine that if you end up, you'll be seeing in our slide later, we're trying to get you to $5 million if you're currently like 35 or 40 now. If that money is taxable versus if that money is never again taxed, what a difference, right? I can spend all the money and I don't even have to worry each year about losing 40% or more to giving it to the government. I mean, it's a game changer.
Yeah, for a lot of urologists, they understand. I hope they understand that they're being taxed at the highest tax bracket, which is around 40%, and that's what Stacy's talking about here. So every dollar you make, 40% you already paid to the government. So you really only have 60% that you actually get to have in your hands. Anyway, that's
right.
Such
and
an
for the
important
people
concept.
that are retiring now, the new Secure Act laws have changed the age for when you have to take your distribution. So they're not even mandating that you take money out of that big pool that you took 30 years to grow. Then by the time you're 72, they tell you, all right, now you have to take out like 5% of the total is what it turns out to be approximately. So if you have 5 million, you're having to take out 250,000 each year. Well, it would be great if some of that is not taxable. So,
all right, back to the slide.
Okay. So if you're an employer, the most important thing to you in retirement planning is working with your financial advisor and working with this third-party administrator to figure out how much do you want to put into your plan for yourself, for the partners, if there are some, and also for the employees. So it's more important. That's a huge concept in and of itself. Not enough, in my mind, people need to spend more time really looking at all those different options. And age is a factor, which we'll go over that later. But anyway, yes. So whenever I'm sitting with clients, we're trying to figure out where's the optimum place? What gives our clients the biggest bang for their buck, no pun intended, and also contributing to their employees. Because it's really important. Sometimes you'll get a recommendation from an advisor. Here over, in this scenario, this is best for you. Well, you can also not just do what's best for you, but you could say, like, can I give a little more if I want to these other? Because what if you only have 2 employees? And what if because of those 2 employees, your practice is thriving and you don't need 3 or 4 employees because they're so great? I mean, this is a great way to give back because you're helping them for their whole life. And I like to, what's that expression? Live my life in that same way. So in my case, I have 1 employee that's been with me 30 years, 1 employee that's been with me 18 years.
Wow.
And 1 employee that's 4 years. She's young, just out of college. So she's, and I just started with another person who's a part-timer. But I have always made it a practice to keep my salaries slightly under competitive rates and give 10% of their salary in a retirement plan contribution. And so in that way, and also education as it comes up, because in that way I'm helping them with the whole of their life, because it's really hard for people to know how to save for retirement. And then I get to teach them at the same time the power of what this amazing strategy can yield. Okay, next slide.
You got it.
How much do you need at retirement? So this is going to be quick. Conventional thinking says 80% of your current earnings. Of course, if you're 35 or 40, that'll be a different number when you're 50 and 60. So you have to think what's going to be 80% of whatever you're earning right before you retire. And then how long will you live? So these are the current numbers, 84.3 for men and women, 87.2 years. So it's a long time to fund for, a long time to save for. Next slide, please. Let's see. Okay. So this is just a really simple slide. It's a first of a few. And this is just to show that if you're earning, on this slide, we're showing someone earning 200,000 and they're 35. And we're just showing that a 6% growth rate of their income is going to have them earning 360,000 by the time they're 67. So when you look at 80% of that, and the green bar at the very bottom on the right, that's Social Security. So there's a lot of red, and the red is what you have to save for. So that's what we're going to talk about next, the shortfall. Can you move to the next slide, please?
Yes.
All right. This slide you might want to go back later and look at because it has a lot of detail. But our TPA, third party administrator, L&S pension, Gary Berman, he put together various ages and all the different ways a person can save through different types of retirement plans. So if you're just, you can do a regular IRA. So depending on your income and if you're in a retirement plan or not, a SEP IRA, a 401k / profit sharing plan, or a defined benefit plan. A SEP IRA probably doesn't apply to most of you unless if you're a sole proprietor and if you don't have that many employees or none. I mean, or if you have, because in a SEP IRA, if you have part-time employees, you actually end up having to put more money aside for them than if you set up a 401k and profit sharing. So you can see, like at age 40, assuming, let's just say you're earning 230,000, you can put up to 57,000. That is the absolute max for this year that you can put aside. That is a combination of that deferral we were talking about of 19,500 and then a profit sharing plan contribution. Now, the defined benefit plan is really best structured for older employees. So if we look at age 55, and if you're earning 230,000, that person could put aside in 1 year, if they had a really profitable business, maybe they had a lot of part-time people that didn't come into the retirement plan, and maybe those people were really young, because a defined benefit plan is a function. Well, first of all, what is it? It's a type of plan that's actuarially calculated based on your age and your income. So that applies to all your employees the same, not just you. So you want to have, if you're older, it's great if you have 20-somethings, a couple 20-somethings, and if your disparity is great. In all of retirement planning, it doesn't matter if you make more than 230,000. I believe that's the highest taxable income. I have a little chart over there I can look at, but close enough, that the government will let you use for calculating these types of plans. Government tries to make sure that you're giving money to employees, that everything is not just all about you, and that you're thinking about your employees. They want to give you a benefit that also helps your staff. Do you have any questions on this, John? Because I know you.
Oh, yeah. These are like 401k and things like that. These are different plans that an employer can implement. And I think most practices or most businesses have at least a 401k. Defined benefit plans have kind of gone away. We have one here in my practice, and like just exactly as you said, Stacy, it's to help not just the employer, but it also helps everyone in the practice. So you're saving money on behalf of the employees, and it's part of their benefit package. And unfortunately, some people don't recognize that whatever they're getting paid, their hourly wages is a part of their overall compensation, and a lot of it is coming in the form of 401k and defined benefit, especially matching. I try to tell all my employees that this is literally free money, that
Right.
if you have a matching 401k. Can you go over what that means? What is a matching
Yeah,
401k?
absolutely. Um, so again, I'm going to try to do it from the employee's perspective and from the employer's perspective. So from the employee's perspective, like you said, it's free money. It's basically saying, if you put in some money, I'll put in some money, like how charities will say, I'll match your charity. So typically it's up to the first 6%. It could also be up to the first 3% or 4%. There are some very common formulas that are done to help encourage participation, because the main thing is, from an employer perspective, we have here's a little bit of a technical thing, but it's called a highly compensated participant. So you want to make sure that the non-highly compensated people, that the average of what they're putting in is only 2% less than the average of all your partners or owners making a lot more money. So there's a formula that the TPA has to watch. This is his job. By the way, a TPA, again, it's like a CPA. So he's in charge of doing the tax return for your retirement plan. Yeah, so you want to take advantage of it on the personal side because it's free money. You should be doing that anyway. I mean, everyone should be trying to do like 10% automatically, hands down. From the employer's perspective, matching is really a great way to meet your obligations, because there is a discretionary testing that's done that, like I was just explaining. And if you don't meet that, you could be penalized by not being able to contribute as much into your 401k plan. So in order for companies to make their numbers, they have to encourage participation. Personally, again, it's another area that Astor Financial Group loves. We love encouraging all the participants to be in the plan. We also, in our company, I don't know about others, but we offer basic financial planning up to an hour per year for each employee to help them in deciding how much to do and to answer any other financial questions, because it's all, again, an integral approach. So how would some person who doesn't have any education in finance know what they can afford? And they're scared to talk about it because they don't make that much money. So it's important to kind of have someone that can, talk with them and help them feel comfortable with participating.
Yeah, it's literally free money, and whatever the employee puts away, the company matches up to a certain percent. And I will say this: having your money taken, withheld or put aside in a 401k automatically, first month you may notice, or first paycheck you may notice it, second paycheck, third paycheck, you won't even miss it. That's
Right.
just human nature. We
You sound like
learn.
me, John. I
You
say that all the
we
time.
learn to live within whatever's in the checking account, and that's just human nature. So whatever's taken away, whatever's being saved for you automatically, and the old adage of pay yourself first, saving for retirement is so important. Putting that money aside and having it automatically withdrawn, you are not going to miss it after
Right.
after 2 to 3 months.
Right.
And I will tell you that's the case for me when I first started. Anyway,
And
sorry, go
and
ahead.
some people get fearful about, choosing a number too high. And so to that I say, if you have a small business, you can modify it as often as your company will allow. And I tell our clients, like, let them change whenever they want, because they're not going to. They aren't. But at least the fear of doing too much will go away. And if it was genuinely too much, they can, roll it back a little. But always better to strive and push a little higher. Let's see. Would you go to the next slide?
You got it.
Okay, so here's our number. For a 35-year-old, we want to be trying to get you in the 4.5 to 5.5 million. This by retirement, which sounds so huge to us that are where we are, but it's true. I mean, already it depends on your standard of living, but we have clients that just retired in the last couple of years, and yeah, we hit the mark. We were at around 5 to 6 million. So it really depends, though, and I just want to say that some people will feel like that's impossible, or I couldn't even try, or maybe they feel like they're 50 and they're way far behind. There's lots of ways to get there, so don't panic. Just slow and steady wins the race.
And having a plan, and having a plan. Yeah.
So in this case, we're showing that you're making, again, the same $200,000, but you're contributing 50,000 of that. So hopefully you have a spouse that's also earning some money. But this would be the optimum situation. Is 57 is the max per year you can put in, and so we're showing 50,000 here with a growth rate of 6%, and you can do it. And that's doing nothing else. So you could still be doing other things, whether it's personal savings, or if you end up with any inheritance, possibly, or if the biggest thing I recommend also is if you do have a starter, your first home is more of a starter home. If you later buy a larger home, consider keeping that first home, because that would be another way to have more retirement income. Because once that mortgage is paid off, I mean, rents, I have my old house in Southern California that I've kept. And when we were living there, rents were like, I'm trying to think, maybe $2,000. And now 20 years later, it's $3,500 a month.
Wow.
So, that's income that you can live on when you go to retire, and it keeps going up with inflation. Rents go up with inflation, so you have an automatic built-in inflation protection. So now we're on the power of compounding and inflation. So again, I think we've kind of, hopefully you understand those two concepts by now. And I'm going to show you on the next slide. This is American Funds, Capital Financial Group, Growth Fund of America. It's one of the largest it's in the top 10 mutual funds. It's in, the Wall Street Journal and Barron's and everything is one of the top 10s. So we're comparing it here. This is a chart from them comparing the S&P 500. And it's 30 years. I think it's 30 years. Yes. And so it's starting in 1991. Now I do want to say, again, getting back to risk, on a scale of 1 to 10, I consider the Standard & Poor Index, which is your top 500 leading companies in various industries. I consider that a 5 on a scale of 1 to 10 in terms of risk. And then the Growth Fund of America is more like a 7, because the objective is strictly growth. Whereas the Standard & Poor's Index, you're getting some growth, but you're also getting companies that emphasize paying a dividend, or providing you some income, and they're not, like a utility stock isn't often looking necessarily to grow. So this shows you the impact of compounding, and you can see the last 2 years have been unbelievable, right? Well, all these years you're just adding more money, more money, more money, more money. It's not necessarily going very far. It's going up and down. And then boom, you get to 2018, 2019, and it really starts to take off. And so you can see that's the doubling effect. Oh, okay. So another concept. Many of you may or may not have heard of the rule of 72. So the rule of 72 is, let's say you're looking to wonder, if I can make 10% a year, how long will it take for my money to double? So you say 72 divided by 10, and it's 7.2 years. So you can do that with any percentage that you're trying to earn and see how long it'll take to double. So you can see here, our money practically doubled in the last 3 years. So that's because we were averaging like, about 28%. Okay, so let's move to the next slide,
Okay.
please. Okay, emergency reserves. I'm kind of going backwards because we started with retirement planning, but I did that for impact because now we know what we have to do. And we know how important slow and steady wins the race is. So, but looking at emergency reserves, there are a lot of people that I will meet that I can tell have fear around money. And they always feel like they're on this little merry-go-round or
A little treadmill.
Little treadmill, right? Little
Hamster
treadmill,
wheel, if you will.
right? Trying to keep up with the Joneses. And so if you set this early, which is hard, I know, especially when you're young and you have all these student loans and you're trying to buy a house and you're doing everything, you might even be starting a family all in these early years, but you have to save for emergency reserves. Every paycheck, you have to just commit, because once you get that established, then when something happens, you're not derailed. You can calmly work on paying off whatever it is over a few months, and then you slowly start building it back up again, and you'll never, be thrown off.
There was an interesting study done by Bankrate.com of over 1,000, just a slightly over 1,000 Americans that in this year, that only 39% of Americans have $1,000 emergency fund, can handle $1,000 emergency. Right. So only 39%. That's pretty scary.
Yeah. Yeah. And I hear all the time, like family members lend money to each other because they don't have it. And so it's nice to, you can see here a list of some things. Even, nowadays, if people are waiting longer, especially I can imagine if you're a female physician and you want to wait longer to have a child, infertility costs are very, very expensive. You have to save for that. Disability, unemployment, and sometimes you're having to help a parent with a long-term care situation, home care. They need help at home or just someone checking in on them, especially if one of your parents passes away and the other one is still alive and needing help. And if you don't live in the same town. And home repairs, of course. But these are for the big things.
Yeah, I'll just throw in an example. Recently, my 89-year-old dad became ill, and we needed 24-hour care to help with pretty much everything. So that was an unexpected expense, and they didn't have it, of course, but it ended up being an expense on my side. So having that padding, that little bit of emergency fund reserves, right, it was tremendously helpful. So he's
right, and it happens a lot of times. Like siblings will talk. Hopefully you have a couple siblings, maybe 3 or 4 ideally, so that you can all pitch in to pay for that kind of care. But in my case, for example, I ended up buying my mom long-term care insurance, when she was in her 60s, because I felt like that was the best way for me to make sure I had things covered for her instead of having to worry about, the cash outlay. And I didn't even feel the need to fund the full amount. But if you can self-fund part of it and buy a small policy for part of it. Okay, next slide, please.
Okay.
So this is on cash flow needs. I mean, really, this is the bulk of what the average person is dealing with, is their everyday money coming in and money going out. So you have your home and your mortgage, you have your federal and state taxes, and also property taxes. And then on the fund side of things, you have to plan for your travel, especially if, there's all kinds of ways to do it, from camping to RVs to luxury travel, but you have to at least put money aside. And some people put it in a totally separate bank account or a separate investment vehicle. And they'll say, like, this is my travel fund. So I'm just putting in money every month and letting it grow. And when we go on vacations, we'll sell whatever we need. And
let me jump back real quick. You mentioned 80% of your total income for retirement, and a lot of us think, oh, our retirement needs are going to be much less. Generally, according to what I've read, your standard of living is probably not going to go down when you retire. You're probably going to want to maintain that standard of living. And same thing as you were talking about saving for travel now, you probably want to save for travel when you retire because that's what a lot of us do, thinking, okay, when I retired, I'm just going to travel. I'm going to go visit different parts of the world and do things like that. So savings is the same now as it is in the future when you retire. That's the way I think of it, at least.
Yeah. And, I was thinking too about, people that get a later start. Yeah, I do have some clients. They were really big hitters, making, over $600,000 a year and spending like everything except maybe the retirement plan that was forced by their practices to put aside. But now that they're in retirement, I mean, the first couple years or maybe the first 5 years, they were spending around at the same rate. But eventually they also saw that they needed to maybe still, and some people, of course, I'm working at different levels with them. But in this particular person's case, it was just a regular 401k and I wasn't as active. And so what he ended up doing is he saw an opportunity in his neighborhood where he loved his new home that he moved into. And he ended up buying another one as a rental. And then that was going up. So he bought a third one. And so then in a few years' time, he sold both of them because one he bought for a son who ended up moving away. But, even in the last 5 years, when you're already retired, you can still make money if you see an opportunity that is good. And that's another point I want to make, which is stay close to the vest with investing in what you understand and know. In this case, he was a real estate lawyer, not a physician. And so he knew real estate. And so he jumped on a personal opportunity that just seemed right in front of him. And the same way, like with physicians, a lot of times we'll buy pharmaceutical stocks. And I think it's important, like whatever you're utilizing, like robotics, whatever you're utilizing, we can pay attention to those kind of companies. And it only takes like one big hit, whether it's Apple or whether it's Tesla or some of these, robotic companies. Any of them can really enhance a retirement plan.
Speaking of Tesla, I will just anecdotally say this. For years, we bought Tesla. I think it was 68.
Oh my God.
For years, I told my wife, because I bought it at her suggestion. I said, "Hey, sweetie, this is the only stock that we're losing money on for years." And now, it recently hit over 1,000. It's crazy.
Okay, well, here's my bragging story. My husband was an aerospace programmer and then later a video game programmer, but he was an Apple developer. And he said, and I would say to him, "Don't you use anything you should buy?" He's like, "Well, I use this thing, Apple, So I was in the mode in my 30s. Every other month, I was spending $2,000 and buying one stock, building a portfolio. So one was Apple. It did horrible. It was in the tank. I was like, "You picked the worst stocks ever," I'm saying to my husband. And so that stock went from $2,000 to $524. That's how awful it was. I was like, "I don't believe this." I think it was like the late 80s. I'm like, I don't want to lose all my money. So I ended up selling half. I mean, $500 was still a lot of money back then. It's probably like the equivalent of 3,000 now. And so I was like, okay, I'll keep half. Okay, that half is worth $675,000. It was only $250 or whatever, 300, whatever it was. Anyway, so there's my compounding story on Apple.
And sometimes
luck.
And luck, like you said, that's a point I wanted to make. Talking about luck, back in the early 2000s, it was some sort of promotional thing, and my brother said, "Hey, you know what? You should invest in this in a stock and buy something in E-Trade." Right. And so I opened up my E-Trade account. And that was my first spot. The first stock that I ever purchased was Total Renal Care. Now is called DaVita. I bought it around 2, and now is trading in a lot, a lot.
Great,
it's outrageous.
Great. Those are exciting stories.
Yeah,
those are definitely.
But a lot of it's luck because I didn't really know what I was doing. It was the first stock that I ever purchased.
Right. I mean, it can be annoying having little pieces of companies in your portfolio. But I'm a believer that if you like it and you liked it for a reason, if really nothing changed except you're just getting whimsically disappointed, then hold on. Because for a small amount of money, you don't want to give up a potential of a big stock, a big gain. Okay, next slide on tax planning.
Got it.
You probably should start going a little faster. So CPAs, they are an integral part of financial planning. Usually, well, if you get a really good one, they're being proactive. But oftentimes we're the one reaching out to them saying, we'd like you to do a projection. So what we like to do is tell all our clients the first week of December, you should provide all your tax data to the best of your ability. It can, give or take. It doesn't have to be perfect, but at least your pay stub and some of your, if everything else is pretty much the same, they can even use those numbers. They have software. They can just put in a couple numbers and run a new projection and compare that with your pay stub to see if you are adequately withholding for the year. I'm really into not having surprises. So when April 15th comes along, you still have 4 months that if the CPA says, oh, we're under withheld by 10 grand, you now have the next 4 months to start working on saving that. So know what you pay in taxes. Everything's digital nowadays. So I just tell people, save all your receipts for home improvements or create a file or an envelope, because one day when you sell your home, that'll save you money on your capital gains. But otherwise, that and charitable donations is really the only things you have to save because everything's online. And actually, you only need to save 3. They used to say 7 years, but now it's 3 years that you have to save your tax returns. Let's see. Okay, I just talked about planning with your paycheck withholdings because that's the #1 common mistake. And when you're early in your career, making a mistake of a few grand can really impact you when you're trying to do so many things. So it's good to stay close to $1,000 plus or minus by the end of the year in the beginning. And also it helps your cash flow if you set up for an impound account. I know some people don't do that, but it's easy to do. And you just call your mortgage company and they will put the property taxes aside as well as the homeowner's insurance into a separate account. So you don't have to come up with one big sum the 2 times you have to pay property taxes. And the last one is more advanced, which your financial advisor should be doing for you. And they should be in touch with your CPA at the end of each year for the people that are already in their 40s and 50s or people that have, gains in their stocks, to peruse your entire portfolio and see if there's any stocks you want to sell that have losses, because you're allowed in taxes to take those losses and offset them against the gains so you pay less in tax. Okay, next slide, please. This is really financial planning 101. I'm giving you a tax return. I know probably very few of you actually look at your tax return, but I'm hoping after this, more of you will and won't be scared. The first 2 pages is your main, the main deal of your entire income life. So I'm going to show you where your income shows up and how much, where your taxes show up. And the whole reason I'm showing this, I have a pet peeve. I can't stand when people say, oh my God, I'm getting, so much money back from the government. It's so great. And it's like, that's not the point. It's more about what is your total tax that you paid to the government, and were you able to cut that amount to get it lower? Instead, it just means that you paid in too much and you let the government hold your money when you could have been, living with more ease if you had it in your pocket. And I'm going to give an example in a second. So here we show taxable income at the very bottom in the highlighted portion, 118,000. This is a very simple return on purpose. Okay, then the second page kind of in the middle of the page. Sometimes it depending on the return you have and how complex your situation is, it might be in a different spot. But here's your total tax, line 24. Then after that, they'll go through the different ways that you may have already put paid taxes, whether it's through your W-2 in the form of your withholding, or whether it's if you had any 1099s, or if you estimated your tax payments. So typically, the more money you make in your 50s, you start working with a CPA, and you might be making some additional estimated taxes on a quarterly basis. You add those two together to see what you've paid in altogether. And that's what, and also you could have had money coming from the previous year's tax return. I don't, once you're in your 50s, I don't usually ask for the money back. I just say, put it to the next year. It makes it easy. And then your total payments are line 33. And then the difference of what the total tax is and what you paid in, that's either your refund or what you owe. Okay, next slide. Oh, I know. I wanted to explain. I have a small financial planning story that's simple, so I thought it would be impactful to share. This is actually an aunt. Her husband died a couple years ago, and so what that means is her Social Security got cut almost in half, even though the spouse ends up getting the higher Social Security of the two people. You, in effect, lose half your income. So I had heard that she was going to sell her house. 75 years old, she can't afford to live there anymore, so she has to move. She built up $5,000 of credit card debt, and she's ready to, do this. And I'm like, wait a minute, can I see a few things? So I had her send me her tax return, and her mortgage statement, and of course, her bank account and credit card statement. So what I found out is that she was withholding taxes through Social Security on behalf of the income that her and her husband were earning. But she was withholding them at the rate expecting that it was double, when her husband was alive. And nobody told her, now that your husband died, you don't need to withhold any of those taxes, because as a single person, you're not going to pay any tax. You're making, just Social Security and a little bit of income. So we stopped that right away. Then I looked at her mortgage statement, and it was a 20-year loan. It wasn't a large loan. Some people would say, well, it'd be great to pay it off. That wasn't going to be possible in her situation. So I said, why not? And it was an okay rate. I think it was like 4%. I said, why don't we look to change that from a 20-year loan? Oh, and she was 13 years into it. So about $250 of principal was being paid down every month. So I said, let's refinance to a 30-year loan. The first couple of years, no money will go to principal. So it's going to save that $250 a month. It's going to save in interest because we got her a 2.75% rate. And then that combined with the withholding that she wasn't doing through she was doing through Social Security, that right there saved about $600 a month. So what she had been doing is, like, again, in the wheel, trying to make it with money and putting things on credit cards and going crazy, not realizing, she's going to get like $2,000 back at the end of the year, but she's got this big credit card and it was just spiraling out of control. So we were able to wipe clean the debt, and she's staying in her house, and she has the option to stay there permanently. So that's the difference of what financial planning is versus just being an investment advisor.
A great principle there. I think knowledge, having the information, and I mentioned this earlier, not knowing what's going on, and not being in that financial world 24/7 like a financial planner is in, puts me at a disadvantage if I didn't have that counsel. And I think that's a great story to illustrate that you need some trusted advisors if you want to make it big.
Right.
Or if you want to live comfortably in retirement.
And also, it's just a good reminder that if someone's getting ready to make a big decision, spend $200 and you can talk to a financial advisor for an hour, and have them at least look at everything and see if that's your best option.
One of my biggest worries is not knowing what I don't know.
Right. Yeah.
And missing
right,
out
right.
on opportunities.
The next slide, please. Risk management. So, hold on one second. Just making sure that I said some of my. Okay, so obviously through your company, you most likely have health insurance, dental, and vision. Dental insurance is one of those things that gets more expensive the older you get. And also, most dental plans only go up to either 1,000 or 2,000. That's the max. So it's really good when you're younger. If you do have a lot of dental work that's needed, try to plan it over 2 years, like the start in November and do, like, if you have 2 crowns or 3 crowns or something big, November, do it in 1 year and then on to the next. And that way you'll get $4,000 and you'll get the discounts that go with it, with the networks. Disability insurance is the most important. Life insurance, again, for some of the younger people, they now sell 40-year term insurance. So when I started out, there was 20-year, and then they added 30-year. That's because we're living so long, and the insurance company, it's not as much risk for them. They know people are living longer, so they feel more comfortable only charging a small amount of money for term insurance. Term insurance is the cheapest way you can go when you need to have a lot of protection. So if you're young with small children, you don't have a lot of money, you can spend $1,000 and get $1 million of coverage. So it's really inexpensive, and you would be having that same fixed amount every year for the next 30 years. And of course, there's also whole life and universal life, and they have a place and a time, and again, someone would need to sit with you and make sure it's the right thing, because they are expensive and you want to get that looked at. You can always use, if not your financial advisor, you can ask a CPA, but don't do it just with an insurance agent. Long-term care insurance, really important to try to get. It's a crazy changing world in the area of long-term care insurance. We've been selling it since 1990, and the landscape has completely changed. Now, most policies will only cover up to 6 years. So, like, if you get Alzheimer's, God forbid, and have to be in a home, it's only going to cover for 6 years. So you would want to stay home as long as possible anyway, and have caregivers so you can have a nice, more quality life. And hopefully by then, all of that will be figured out and it won't be an issue. And auto and home insurance. Yeah. In times like these, where we are seeing some inflation, and also with the pandemic, it's created a lot of movement in the United States, and home values are going up in certain areas. So make sure you check your homeowner's insurance and that you're adequately insured under the liability. Also, here in California, we have fires to contend with. So you really need to make sure that your belongings and your liability insurance part of the homeowner's insurance is covered.
If I can interject here, Stacy,
Yeah.
For physicians, you are big targets, and umbrella insurance is something to consider too, meaning things that are not covered under the home, auto, some sort of a blanket coverage. Think of it as an umbrella to make sure that, like, for instance, you could have a friend over and that friend trips and falls. Well, because of your status and your potential net worth, you have a big target on your back. So having that type of insurance is also, you should consider it.
I love that you mentioned it, because I should have had it on there.
Oh, it's okay.
Yes, there's personal umbrella, and then there's a business umbrella. You can have both, and I highly recommend it. It's especially if you have a rental property, you would want it, and you can write it off on your return. If, like, with malpractice insurance, I mean, I don't exactly know, but I imagine that if something was like a little bit out of the box, that the umbrella policy might kick in. But in general, if you're ever sued for anything, if the coverages you have don't insure you, then that umbrella policy will kick in. And they also cover legal fees. So, I mean, one of the classic cases was the whole Monica Lewinsky and with Bill Clinton is that his umbrella policy paid for the legal fees.
I didn't know that.
Yeah, that's what I heard. So, no, that's an important topic. Let's see. Next slide.
Go ahead.
Okay, so my overall points of the whole talk is start saving early or as soon as you can. Slow and steady wins the race. Create a team of advisors who will be there for you, that are trusted, honest, have integrity, care about you and your family and your goals. Maintain the work-life balance. One of my urologist clients years ago said to me, I can't take vacation. Like, I make too much money to take vacation. And, I get it. Like when you look at how much you're giving up when you take time off, you're like, oh my God, it's costing me to leave. But how long do you want to live? And do you want to get disabled? Because if you do not take care of your body, that's truly your biggest asset. And also you have a family you have to care about. And so spending time with them is so important, because if you forget that you're doing this for your family and for your children, and you work too hard and you don't spend enough time with them, what was the point?
So I always try to learn from my patients who are older, and I will ask for advice sometimes. What would you give yourself? What advice would you give your younger self if you could? These older patients, and my dad, and a lot of them will say, especially my dad, he'll say, your health is the number one thing. That's the most important thing. At 89, so he's been telling me this for a long time. Your health is the number one thing, and then money can come in second if you have it.
Right.
And something that's been said over and over: no one on their dying bed is going to say, "Gosh, I wish I had done more cystoscopies," or "I wish I had done more cystoscopies or more vasectomies." It's always, "I wish I had spent more time with my family."
Right. Absolutely. Yeah, it's really so true. When you're working and you're focused and that's your, when you work a lot, you can get into a rut where that is what feels normal, and it takes a lot of work. I tell my nieces and nephews that the best thing they can do for themselves is practice letting go of either friends that they're not really that close to, or an obligations that they don't really feel passionate about, or hobbies that they're really just not into, but they're still doing, because practicing letting go is something that we're not used to. And as we get older, in order to be fully present, we have to let go of some of the other stuff.
So true. Oh, I know we've been soliciting questions throughout the presentation, and I don't see any in the comments. So if there's anybody with last minute questions, please feel free to put them in the comments. Or if you feel like you want to ask these questions directly, I'm going to put on the screen the slide for Stacy and her team, some of her team.
Right. So Cece's on the left and Allison is on the right. Unfortunately, Janine's not in my picture here. And also a reminder. So my website is Astor FG for Financial Group .com. And we have a huge volume of 1-minute video clips that I started watching a lot of them for this talk. And I thought, oh, I have to start promoting these, because they're like mind exploding within just 1 minute on certain concepts. Also some really good reading material. Kiplinger's I like, and Money Magazine for a book, Understanding Wall Street, is really good. And The Soul of Money, which talks about looking at your attitudes towards money and a philosophical approach. So thank you so much again for the opportunity. I hope you guys learned from this, and feel free to email any questions.
Wow, it's been a great talk. It's so important to cover so many topics. Each topic you can probably spend a week or more discussing. So thank you so much for sharing your beautiful, Great topics, great stories. Thank you so much, Stacy, for sharing
Appreciate it,
your
John.
time and information with us.
You're welcome. Thank you.
All right. For those of you with questions, additional questions, or if you have any questions that you don't want to ask in public, feel free to reach out to Stacy and her team. Or if you want to DM me, I'd be happy to forward your information to Stacy and her team. Thank you so much for watching. Have a good day. Bye-bye.